If you are over 60 and still punching the clock, the IRS has quietly set up 3 massive wealth traps that are siphoning away your retirement savings right now. You might think those extra years of salary are securing your future, but thanks to a hidden tax torpedo, mandatory healthcare surcharges, and a brand new 2026 tax law, working longer could actually be costing you more than you're taking home. Welcome back. In July of 2025, a massive piece of legislation completely overhauled the tax code for 2026. While everyone was distracted by the headlines praising the new bonus tax deduction for seniors, the IRS permanently locked in a series of income traps specifically targeting older Americans who choose to keep working. Over the next few minutes, I am going to walk you through exactly how your hard-earned paycheck is triggering phantom taxes on your Social Security, exploding your Medicare premiums, and pushing you into a retirement tax bomb that you never saw coming. By the end of this video, you will know exactly how the system is rigged against the older worker, and more importantly, exactly how to protect your money. The unspoken reality of working in your 60s. Let us start by addressing the elephant in the room. You are working hard. You have likely spent the last 4 decades contributing to the economy, raising a family, paying your taxes, and doing everything society asked of you. When you reach your 60s, the conventional wisdom pushed by financial planners and the government is that working just a few bonus years will dramatically improve your retirement security. They tell you to delay Social Security. They tell you to pad your 401k. They tell you to keep generating earned income so you do not have to touch your nest egg. On paper, this sounds like bulletproof advice. It feels responsible. It feels safe. But there is a glaring, dangerous omission in this conventional advice. The financial industry rarely talks about the aggressive, compounding, and highly punitive nature of the United States tax code when it comes to older workers. You are no longer just an employee in the eyes of the IRS. You are a target. When you blend earned income from a job with the various streams of retirement income you might already be tapping into or preparing to tap into, you create a toxic financial cocktail. You enter a phase of life where earning an extra dollar does not mean putting an extra dollar in your pocket. In some of the most shocking scenarios, earning an extra dollar can cost you $1.50 in lost benefits and new taxes. This is not an exaggeration. This is the mathematical reality of the modern tax system. The government knows exactly what it is doing. The system is designed to claw back the benefits you spent a lifetime funding simply because you have the audacity to continue earning a paycheck. We need to dismantle this illusion of catching up. We need to look at the cold, hard numbers. I want you to understand exactly what happens to your tax return when you turn 60, 62, or 65 and decide to keep swiping that employee badge. The Social Security Tax Torpedo. Let us dive into the first major trap, one that devastates millions of older workers every single year. I am talking about the Social Security Tax Torpedo. Many people over the age of 62 decide to claim their Social Security benefits while continuing to work full-time or part-time. You might think, I paid into the system my whole life. I am entitled to this money, and I want to enjoy it while I still have my health and my job. But the moment you combine a paycheck with a Social Security check, you awaken a dormant section of the tax code that was explicitly designed to penalize you. Here is how the trap is set. The IRS does not just look at your gross income to determine how your Social Security is taxed. They use a highly specific, highly damaging formula called provisional income. To calculate your provisional income, the IRS takes your adjusted gross income, adds in any tax-exempt interest you might have from municipal bonds, and then adds exactly 50% of your Social Security benefits. Once they calculate this number, you are subjected to a brutal set of thresholds. If you are single and your provisional income is between $25,000 and $34,000, up to 50% of your Social Security benefits become taxable. If your provisional income exceeds $34,000, up to 85% of your Social Security benefits are subject to federal income tax. If you are married filing jointly, the thresholds are only slightly higher. Between $32,000 and $44,000 exposes 50% of your benefits, and anything over $44,000 exposes up to 85% of your benefits to taxation. Think about those numbers for a moment. $34,000 for a single person, $44,000 for a married couple. Those thresholds were set in the early 1990s. They have never been adjusted for inflation. In 2026, a married couple earning just $45,000 is practically living near the poverty line in many parts of the country. Yet the IRS treats them like wealthy aristocrats, taxing up to 85% of their Social Security. This is where the term tax torpedo comes from. Because you are working, your paycheck easily pushes your provisional income over that upper threshold. Let us look at a realistic scenario. Imagine you are married, you are both 66 years old, and you are receiving $30,000 a year in Social Security benefits. If you were fully retired and had no other income, you would pay zero federal income tax on those benefits. None. But let us say you decide to keep working and you earn $40,000 a year at your job. That feels like a modest income, but let us run the provisional income math. The IRS takes your $40,000 salary, adds half of your Social Security, which is $15,000, bringing your provisional income to $55,000. You have just blown past the $44,000 maximum threshold. Suddenly, a massive portion of the Social Security you thought was yours free and clear is dumped right onto your tax return as taxable income. The true devastation of the tax torpedo is found in your marginal tax rate. For every extra dollar you earn at your job, you are not just paying income tax on that dollar. That extra dollar of salary pulls another 85 cents of your Social Security into the taxable column. You are being taxed on $1.85 of income for every $1 you actually earn. This creates a hidden marginal tax bracket where middle-class seniors working moderate jobs are suddenly paying marginal tax rates of 22%, 24%, or even 40% on their next dollar of income. You are sweating at your job, putting in the hours, dealing with the commute, all to hand over a massive premium to the federal government. They are double dipping. They taxed you when you earned the money to fund Social Security, and now they are taxing the benefit itself simply because you are still employed. If you are working while claiming Social Security, you must evaluate whether your net take-home pay justifies the time and energy you are expending, because the IRS is taking a massive disproportionate cut. Did you know that out of the tens of millions of seniors currently receiving Social Security, over half will pay taxes on their benefits this year, up from just 10% in 1984? Think about how dramatically the goalposts have been moved on your retirement. The 2026 tax law shift and the phantom deduction. Now, let us move to the second trap, which is brand new for this year. You need to pay very close attention to this because it directly impacts your 2026 tax filings. In July of 2025, Congress passed a massive tax package that made the previous temporary tax brackets permanent. This locked in the standard tax rates we are familiar with: 10%, 12%, 22%, 24%, 32%, 35%, and 37%. It also permanently locked in the higher standard deduction, which for 2026 is $16,100 for single filers and $32,200 for married couples filing jointly. But the politicians wanted a victory lap, so they introduced something new specifically for older Americans. They proudly announced a brand new bonus deduction for seniors. If you are aged 65 or older in 2026, you are supposedly entitled to an extra $6,000 standard deduction per person. That means a single senior could claim $22,100, and a married couple where both are over 65 could claim a massive $44,200 standard deduction. When this was announced, it sounded incredible. It sounded like the government was finally giving seniors a break. But you know the IRS better than that. The IRS rarely gives with an open hand without keeping the other hand closed tightly around a trapdoor. Here is the sinister catch that the headlines conveniently ignored. The $6,000 bonus deduction phases out based on your income, and the phase-out limits are brutally low. If you are a single filer, the bonus deduction begins to vanish once your modified adjusted gross income reaches $75,000. If you are married filing jointly, the phase-out triggers at just $150,000. This is a direct penalty on seniors who are still working. If you are fully retired and living on modest withdrawals, you get the deduction. But if you are over 65, working a decent paying job, perhaps taking a small pension, and maybe doing a little consulting on the side, you will easily hit those phase-out limits. Imagine a 66-year-old engineer who decides to work a few extra years. He earns $85,000. He is not a millionaire. He is just trying to pad his savings against inflation. Because he is working, his income exceeds the $75,000 threshold. He completely loses the $6,000 bonus deduction. This creates what accountants call a cliff effect or a shadow tax. By working and earning that extra money, you are actively destroying the tax deductions that the government claims are meant for you. You are losing a $6,000 shield against taxes. If you are in the 22% tax bracket, losing that $6,000 deduction literally costs you $1,320 in hard cash right out of your pocket, straight to the federal treasury. The government engineered this new 2026 law to look like a massive relief package for seniors, but they quietly embedded an income test that disqualifies the exact people who are still actively contributing to the workforce. You are being punished for your productivity. You are being penalized for your work ethic. You are funding the tax breaks for everyone else while you are explicitly excluded from the benefit. If you are over 65 and working, you must calculate your projected 2026 modified adjusted gross income right now. You need to know exactly how close you are to that $75,000 or $150,000 cliff. Every dollar you earn over that line is functionally taxed at a much higher rate because of the vanishing deduction. Working more might just mean giving the IRS exactly what they need to deny you relief. The RMD time bomb and bracket creep. As we continue ascending into the ways the tax code targets older workers, we arrive at the third trap. This one is insidious because it is a problem created by your own good habits. I am talking about required minimum distributions, or RMDs, and the disaster of bracket creep. For decades, you have been told to contribute to pre-tax retirement accounts, traditional IRAs, 401ks, 403bs. You deferred the taxes when you were younger, with the expectation that when you retired, you would be in a lower tax bracket. But what happens if you don't retire? What happens if you are in your 60s or early 70s? You are still earning a high salary, and those tax-deferred accounts have ballooned in value due to market growth. You are building a massive tax bomb, and the fuse is burning. Under current law, depending on the year you were born, the IRS forces you to start taking money out of those pre-tax accounts at age 73 or 75. These forced withdrawals are called required minimum distributions. You do not have a choice. If you do not take the money out, the IRS hits you with a massive penalty, up to 25% of the amount you were supposed to withdraw. Here is why working later in life turns this into a catastrophe. When you delay retirement and keep working, you naturally delay tapping into your 401k or IRA. Because you are not withdrawing the money, it stays in the market, compounding and growing larger. By the time you hit your RMD age, your account balance might be double what it was at age 60. Because the account balance is massive, your required minimum distribution will also be massive. And remember, every single penny of an RMD is taxed as ordinary income. Now imagine you are 73 years old. You are still consulting or running your small business, bringing in $100,000 a year. You are also receiving $40,000 a year in Social Security. Your income is already high. Then, the IRS forces you to take a $60,000 required minimum distribution from your IRA. You have instantly added $60,000 of pure taxable income to your tax return in a single year. You have just triggered a devastating phenomenon known as bracket creep. That forced withdrawal pushes your total income into a completely new, much higher tax bracket. You might have lived your whole life in the 12% or 22% bracket, but suddenly, because you worked longer and let your accounts grow, the IRS is taxing your withdrawals at 24% or 32%. You saved diligently, you worked hard, you delayed gratification, and your reward is that the federal government becomes a hostile partner in your wealth, taking a third of your life savings in taxes simply because you accumulated too much while continuing to earn a salary. The tragedy here is the loss of control. When you are fully retired with no earned income, you control the spigot. You can withdraw just enough from your IRA to fill up the lower tax brackets, perfectly optimizing your tax burden. But when you are still working, your salary fills up those lower tax brackets first. The standard deduction, the 10% bracket, the 12% bracket, those are all completely eaten up by your W-2 wages. Therefore, any money forced out of your retirement accounts via RMDs automatically stacks on top of your salary and gets taxed at your highest possible marginal rate. This is the hidden cost of working longer. You are inadvertently setting yourself up to pay the highest possible taxes on your retirement savings because you are combining peak earning years with forced distribution years. But as bad as losing your Social Security to the tax torpedo is, and as frustrating as bracket creep and vanishing deductions are, there is an even more insidious penalty hiding in the shadows. It is a penalty that the government deducts straight from your bank account without your permission. It is a penalty that completely ignores your deductions and targets your gross income. I am talking about IRMAA, and I will reveal exactly how to dodge it in just a moment, but first you have to understand the math. IRMAA, the ultimate hidden wealth confiscation. We have arrived at the final, most financially destructive, and deeply counterintuitive trap for anyone working over the age of 60. It is a trap so aggressive that it functions as a stealth wealth confiscation tax. It is called IRMAA, the Income-Related Monthly Adjustment Amount. Most people believe that Medicare Part B and Part D premiums are a fixed cost. You turn 65, you sign up for Medicare, and you pay your standard monthly premium, which in 2026 is $202.90 a month. But if you are still working, earning a strong salary, and making the mistake of generating a high income, the federal government fundamentally changes the rules of the game. IRMAA is a surcharge. It is an extra tax slapped onto your Medicare premium strictly because you make too much money. But unlike normal income brackets that grade smoothly, IRMAA is designed as a series of brutal, unforgiving cliffs. Let us look at the 2026 numbers. In 2026, if you are a single filer and your modified adjusted gross income is $109,000 or less, you pay the standard base premium of $202.90 per month. If you are married filing jointly, that safe harbor threshold is $218,000. But what happens if you earn more than that? What happens if you are a single person and you earn $109,001? Because you went exactly one single dollar over the limit, you fall off the first IRMAA cliff. Your Medicare Part B premium instantly jumps from $202.90 to $284.10 per month. But it doesn't stop there. You are also hit with a surcharge on your Medicare Part D prescription drug plan, adding another $14.50 per month. You earned one extra dollar. And the government responds by taking hundreds of dollars away from you in mandatory healthcare surcharges. And the cliffs only get steeper. If a married couple filing jointly earns over $274,000, their premium spiked to $405.80 per person per month, plus $37.50 for Part D. If they earn over $342,000, it jumps to $527.50 per person. And if you are highly successful, earning over $750,000 as a couple, you will pay a staggering $689.90 per person per month, plus a $91 Part D surcharge. That means a married couple in the highest IRMAA bracket is paying nearly $19,000 a year just for basic Medicare premiums. This is where working in your 60s becomes deeply hazardous. If you are 65, enrolled in Medicare, and continuing to work, your salary is the exact fuel that drives you over these IRMAA cliffs. Every bonus, every overtime shift, every commission check you receive at work threatens to push you over a threshold and trigger massive, non-negotiable premium spikes. But here is the most terrifying and misunderstood part of IRMAA. It operates on a 2-year look-back period. The Social Security Administration does not look at what you are earning today to determine your premiums today. They look at your tax return from 2 years ago. This means your 2026 Medicare premiums are dictated entirely by the income you reported on your 2024 tax return. Let that sink in. Imagine you had a massive earning year in 2024. You were working full-time. Maybe you sold a piece of property, or maybe you converted a portion of your traditional IRA to a Roth IRA. Your modified adjusted gross income spiked to $250,000. Now it is 2026. You are 66 years old. You have cut back your hours at work. You are transitioning into retirement. Your current income has dropped to a very modest $80,000. You feel like you are safely under the radar. Suddenly you get a letter from the Social Security Administration. They inform you that because of your 2024 income, you have been hit with a massive IRMAA surcharge. Even though you are only making $80,000 right now, They are going to forcibly deduct top-tier Medicare premiums directly out of your Social Security check every single month. Your take-home Social Security benefit shrinks, your monthly cash flow is crippled, and there is almost nothing you can do about it because the tax was based on a ghost of your past income. Working over 60 requires extreme surgical precision with your income. A single error, like selling stock with massive capital gains or taking a year-end work bonus, can result in a catastrophic IRMAA penalty 2 years down the road when you can least afford it. IRMAA is the ultimate stealth tax because it is not listed on your 1040 tax return. Your CPA might not even warn you about it. It just quietly shows up in your mail, instantly eroding your standard of living. Are you beginning to see how the system is rigged? Every system, from Social Security taxation to vanishing deductions to RMD bracket creep to the IRMAA cliffs, is mathematically engineered to punish the senior who chooses to keep working. Actionable defense strategies, how to protect your wealth. Now that you see the traps, now that you understand how aggressively the IRS is targeting your continued employment, we must pivot to defense. You do not have to accept this as your fate. If you are working over 60, you have options, but you must act with deliberate, proactive strategy before the tax year closes. Defense strategy number 1. The strategic Roth conversion. If you are still working and building up a massive pre-tax 401k or IRA, you are feeding the RMD time bomb. You need to diffuse it now. You should be aggressively looking at Roth conversions. A Roth conversion involves taking money out of your traditional pre-tax account, paying the taxes on it today, and moving it into a Roth IRA. Once the money is in a Roth IRA, it grows completely tax-free forever. More importantly, Roth IRAs do not have required minimum distributions during your lifetime. By paying the tax now, ideally during years when your income might dip, or by carefully filling up your current tax bracket without spilling over into the next one, you permanently remove that money from the IRS's reach. You eliminate bracket creep in your 70s, and you protect yourself against future tax rate hikes. Defense strategy number 2. Master the health savings account. If you are still working and enrolled in a high-deductible health plan, the health savings account, or HSA, is the most powerful tax shelter in the federal code. Contributions are tax-deductible, growth is tax-free, and withdrawals for medical expenses are completely tax-free. And for 2026, the rules have gotten even better. New provisions in the 2026 tax law allow expanded eligibility for telehealth and direct primary care arrangements using HSA funds. More importantly, every dollar you put into an HSA directly lowers your adjusted gross income. This is your primary weapon against the IRMAA cliffs and the $6,000 bonus deduction phase-outs. If you are $3,000 over the IRMAA threshold, maxing out your HSA drops your income right back under the cliff, saving you thousands in Medicare surcharges. Defense strategy number 3, qualified charitable distributions. If you are philanthropic and you are dealing with required minimum distributions, you must stop writing checks to charity out of your standard checking account. Instead, utilize a qualified charitable distribution, or QCD. A QCD allows you to transfer funds directly from your IRA to an eligible charity. The beauty of this maneuver is that the money satisfies your RMD requirement, but it is never counted as taxable income. It bypasses your tax return entirely. It does not inflate your provisional income, meaning it will not trigger the Social Security Tax Torpedo. It does not inflate your MAGI, meaning it will not trigger an IRMAA surcharge. It is the most mathematically efficient way to give money away while keeping your taxable income artificially low. Defense strategy number 4, control your capital gains. If you are working, you must ruthlessly monitor your investment portfolio for taxable events. Mutual funds often distribute capital gains at the end of the year, even if you did not sell a single share. These phantom distributions increase your MAGI. If you are right on the edge of an IRMAA cliff or the $75,000 phase-out limit for the senior bonus deduction, a surprise $5,000 capital gain distribution from a mutual fund could trigger thousands of dollars in penalties. You must work with your advisor to transition into tax-efficient investments, like exchange-traded funds, or utilize tax loss harvesting to neutralize any gains before December 31st. You have to shift your mindset. When you were 40, financial planning was all about accumulation. How much can I save? How fast can it grow? But when you are over 60 and still working, the game fundamentally changes. The game is no longer about accumulation. It is about tax mitigation and income location. It is about understanding the exact thresholds where the IRS turns from a passive collector into an aggressive confiscator. You cannot navigate this with a set it and forget it mentality. You cannot simply trust that doing the right thing by working longer will automatically reward you. The tax code for older workers is a minefield. The government has built a system that actively punishes those who continue to produce, using invisible triggers like provisional income, 2-year lookbacks for Medicare, and disappearing standard deductions. But armed with the knowledge of these thresholds, you can outmaneuver them. You can cap your income just below the cliffs. You can drain your pre-tax accounts strategically. You can shield your W-2 wages using legal deductions. You have the power to keep the money you spent a lifetime earning. Let us quickly recap the harsh realities we have uncovered today. First, combining W-2 income with Social Security triggers the tax torpedo, potentially taxing up to 85% of your benefits and creating a massive marginal tax rate on your labor. Second, the new 2026 tax law touts a $6,000 bonus deduction for seniors. But if you are single making over $75,000 or married making over $150,000, that deduction vanishes, punishing you for continuing to work. Third, delaying retirement means your 401ks grow larger, leading to massive required minimum distributions in your 70s that will stack on top of your other income and trigger devastating bracket creep. And finally, your current income dictates your future Medicare premiums through the vicious IRMAA 2-year lookback. Going just $1 over an IRMAA cliff can cost you thousands in unrecoverable surcharges. You have worked entirely too long and entirely too hard to let a predatory tax code bleed your retirement dry in the final quarter of the game. Stay vigilant, stay proactive, and always run the tax math before you accept that extra hour of overtime. Now I want to hear from you. Have you been blindsided by a massive tax bill on your Social Security or a sudden spike in your Medicare premiums because you decided to keep working? Comment your experience down below so others can learn from what you went through, and make sure you subscribe to stay ahead of the IRS.